Hey everybody, welcome back to the REI Marketing Secrets podcast. Today on the show, we have Ed Mathews. Ed, super excited to have you on the show today. And Ed, for our audience out there who's like, who the heck is Ed Mathews? Do you mind just going a little over into your background and how you got started into real estate investing?
So,
And when it comes to multifamily, there's any number of asset classes within the real estate space. You could go into your self storage, your mobile home park, obviously multifamily. What really drew you to multifamily other than, say, these other asset classes that are out there?
twofold. One, Maslow's hierarchy of human needs, right? The
Mhm.
fact is that shelter is something that all human beings are going to always seek, and you look at how this asset class has performed over the last 50 years, including being stressed in 87, 91, 99 through 2001, 2008, and and so on. And by and large, value add multifamily, particularly C and B class, tend to weather those storms very efficiently and effectively. Values tend to get hit, but the fact is that from a cash flow perspective, rents tend to at least maintain stability, and in most cases, at least trend with inflation, which is a good thing.
Yeah, people definitely need housing.
Yeah,
It's always a given.
yeah. So there's that, and then the other part of it is I'm drawn to it because I really, and I have a passion for it. I think it probably stems from the fact that growing up as a kid, I was one of those kids that lived in that type of an apartment, and I watched my mom work two, sometimes three jobs just to make ends meet. And so I feel a connection with the folks that live in our buildings, and I don't know that they know that, but nevertheless, I do. I sleep well at night knowing that we're taking real good care of those folks because, you know, like I said, I was that kid once.
Yeah, that's awesome to hear. You find that so many operators are coming in, they're trying to cut costs, and as a result, the experience of the tenant is not great. And then
Yeah,
sometimes when they don't have great tenants, that could lead to other problems coming up within the
right.
properties. And it's at the end of the day, it's a human. I mean, you can
That's
look at
it.
it as numbers on a payroll and revenue and expenses, but it's really a person at the other end that's going to be renting out this property. So I really like that.
Yeah, and
Well,
and here's the thing, Trevor. The fact is, and I was talking about this yesterday with an investor, somebody who's looking at us, and the if you put a 20 unit building on the left and our building, same identical building on the right, and you you look at how they operate, right? The fact is that when residents are live in a clean, safe, well appointed place where they're proud to live, they tend to stay for a really long time. And like, looking at every quarter or so, we snap a line and take a look at this. And the average tenancy in the state of Connecticut, which where most of our portfolio is, tends to be about 17, 18 months, which means people are leaving pretty much every other year, right? And so in our buildings, our average tenancy is just a click above 4.1 years. And so the cool part about that is kind of twofold. One, I get to lay my head on the pillow every night knowing we're doing right by the folks that live in our buildings. But two, our buildings are also more valuable and cash flow better. And here's why. They tend to, when people live in a place where they feel heard, respected, where everything's nice and things are well cared for, they tend to pay their bills on time. They tend to, uh, uh, especially rent. They tend to stay a really long time, and I'll get into that in a second. And they take excellent care of the building because they want to keep it nice, right? And so what happens is that lack of turns, that lack of having to do lease ups, saves us per unit. It could be thousands of dollars a year. And so that money drops right to our cash flow, right to our bottom line. pretty much. And so, that increases NOI, which increases the value of these buildings. And so, when we go into a neighborhood, we're fairly confident that, we can turn around a building very quickly and relative to its peers outperform, within a matter of a year or two.
I want to talk about the property management aspect of it. I've lived
Sure.
in two different apartments. One had a great property management team. They were friendly. Anytime I had an issue with the apartment, super easy to work with. Conversely, moved a little bit closer so my wife could be closer to work. New property management team, totally different apartment,
Yeah,
owner. And I
right.
found with them things where you'd run into where there'd be first day we walk in, there's no dish in the dishwasher rack. It's just it's basically empty. Things like that. Even though they signed off that they checked it,
Right.
we had a light bulb go out. I don't know, that maybe first week or two we were there, and they wanted to charge us like $30 to fix it. And not that we were paying super expensive rent. It was probably a Class B property, but I mean, we were still paying like 2 grand a month for rent, and it was just
Yeah.
mind blowing to me comparing one location to another location. And then it was almost like we couldn't wait to get out of there. And then
Right.
anytime
Exactly.
we had a problem, it would take forever to people to come
Exactly.
in and get the problem fixed. But just on your end, when it comes to the property management team, is that just such a key essential part of just that whole tenant experience?
100%. And that's actually why we worked with local property managers for years, and had some good experiences and some not so good experiences. And that inconsistency taught me and our team that we were better off bringing that in in-house and creating Clark Street management. And so that's what we did. We don't manage other people's apartments, we just manage our own. But that way we knew that the residents, when they called and they got yes sir, yes ma'am, no sir, no ma'am, we'll be right out and actually follow up. When the problem is solved, somebody follows up to make sure that the problem is solved. Um, you know, Thanking them for living in our buildings. Eh, the point that kind of rang home for me is I was at an event, MM5, a few years ago, and I don't remember if it was Jake or Gino, but one of them said they wanted to be the Chick-fil-A of multifamily, and I said, yes, that's exactly it, right? You ever go to a Chick-fil-A and somebody serves you and you say thank you, and what do they say? It's my pleasure every
Mhm.
time, right? And so we have taught our team to react the same way. These are human beings. This is their home. And if they've got a problem, we need to solve it because we want them to be happy, because we want them to stay. It's easy.
Yeah, I think you look at Chick-fil-A, you pretty much go look at any Chick-fil-A outside of Sunday, it's gonna be it's gonna be packed no
Right.
matter whether it's
Exactly.
9 AM, 5 PM, so that's a great analogy
Yeah.
there. And I was just thinking of another story where with our property management where I think it was, again, the first couple of weeks we moved in using the oven, and it had, like, this very strong gas smell, so walked outside, called the property management team, they're like, "Oh, it's okay, just go back into the apartment, we'll check it out tomorrow." And I'm thinking, "Oh my gosh, could this be, like, a gas leak?" And I don't know if it was, but they didn't really do anything to, like, make me feel better. Per se,
Yeah.
where the other company you call up, they get back to you, rather quickly, so definitely kudos to you and bringing that in-house property management team, because I find a lot of operators where they run into issues is they do find great deals on these properties, but then when it comes to managing the property,
That's where they
that's where
fall
that
apart.
downfall is, and they try to use a third property management team. They don't take that extra step like it sounds like you and your company does to build out that property management team. And how has that been building out that property management team to help you manage your properties?
It's a challenge, right? I mean, finding the right people with the right mentality to, it's a lot of the folks in this business aren't necessarily customer oriented, right? It's not necessarily a service oriented business. It's very much a transactional business, and so finding the right people to work. A lot of cases, we're pulling people out of other industries to be able to pull them into this. And the thing is that as we've begun to extend our portfolio, one of the things that we're kind of working through literally right now is, as we acquire a building and we find a quality property manager in place, do we keep them or do we kind of hybrid and say, okay, you're going to be feet on the ground, but we're running it, which is, I think, where we're landing. Or do we, over time, hire our own people in that area? And I think we'll get there. But at least they are crystal clear when we go in and acquire a building, say down in North Carolina, that they understand here is the expectations. We've got a whole orientation package that we take our team through. And the property managers that are going to work with us, they've got to go through it and they got to buy in. And if they can buy in, great. And if they can't, well, then they're just not a good fit, and we'll figure it out. But I think that's kind of where we're landing is outsourcing some of the day-to-day maintenance, the handyman or the superintendent, the plumber, the electrician, the HVAC folks, and everybody else is going to be Park Street employees. So
Yeah, that's
it works
perfect. I
so
think
far.
having that team member on your team is key. Making sure that they're the right
It
fit
is
and,
indeed.
and making sure they're just because they're coming over from the previous, I would say regime or however you want to call operator, I should
Right.
say, coming
Sure.
over from the previous operator, you want to make sure that they're still doing a good job with their company. But with that said, I know you mentioned earlier or a little earlier in our conversation that your company invests in Connecticut. Are there any other states outside of Connecticut or locations within the country that you look to invest in?
So we are aggressively moving into North Carolina. We just started that at the beginning of this year. We're making offers left and right. Basically making at least 2 or 3 offers a week on buildings, and we're in negotiations on several of them, and we'll see how that shakes out. But the fact is that in order for us to grow here in Connecticut, our objective is to get to 1,000 units by the end of 2025. The only really way to do that is by much bigger buildings. And so the the buildings that we would normally target, they don't live here in Connecticut, right? Connecticut is more of an old New England.
Mhm.
You can buy 6 units, you can buy 8 units, you can buy 10 units. There are very few 250 unit apartment complexes, and the ones that are owned have either been in the same family for 100 years, or they're owned by a big conglomerate or a big PE firm. So uh, so that's when we started to look at other states. North Carolina fits the bill. It's a landlord-friendly state. It is, there's plenty of opportunity from a value add perspective. The job growth is exceptional. The population growth is equally good. There's a diverse population of employers. Median incomes are right on in terms of relative to rents. So yeah, there's great opportunity there. We are looking at other states like Kentucky and Indiana and Ohio, and we're more opportunistic there. But the focus right now is to find that anchor building in North Carolina, plant the flag, and then buy several hundred units around it.
That's an awesome strategy. And I don't know if it's from being New England myself growing up in Massachusetts and then now moving over to New York. But when I was down in North Carolina a couple months back, I found the people to be a lot more friendlier
That's
than,
true.
than the people in Massachusetts
That's true.
and New York. I'm assuming Connecticut too. When you're driving
That's true.
around and you're getting honked at and people are swearing at you, where North Carolina, I'm like, this is nice. People are
Southern
friendly.
hop-
I don't know if it's the weather or what
Southern
it is.
hospitality is a real thing.
Yeah, yeah, exactly. But when it comes to these deals, you're finding and really looking over, say, the last year and
Sure.
a half or so, obviously a lot of multifamily operators have taken a big hit just on how they've financed their deals and different things like that. But curious how your company has been over the last year and a half, and then also going forward when it comes to finding these new deals, when it comes to like structuring them and just making sure that they're going to be okay. Because again, you hear some of these operators just over leverage. I mean, you can sort of tell, with their bridge debt and their
Right.
LTV and their, the coverage ratio where they're going to be make a mistake. But curious when it comes to your company, and just because I find it is a little bit of a hot button topic within the multifamily space is,
Yeah.
how the different operators are structuring their deals based on how everything's been going down.
Yeah. So with the smaller deals here in Connecticut, we would acquire properties with 30-year debt, and then use either our capital, and/or our partner's capital to rehab the properties, and then hold on for a really long time. As we refi out or we decide to sell a property to trade up, that's when we're returning capital. As far as the properties, the much larger properties, honestly, I'm inclined to do the same thing because I would rather give up equity to really good partners than sign up for bridge debt that has some sort of variable in it that
Hmm.
I can't predict. The fact is that if you go on Twitter, right, and you listen to all the folks on Retweet and the mortgage, there's a lot of knowledge out there. There's a lot of experience, and they don't know. I don't know. Do you know? There's no crystal ball, right? I have no idea what the Fed's going to do over the next 2 to 3 years. Are they going to drop rates? Maybe, probably. When? Don't know, right? And so that's not predictable. But what is predictable is the fact that, even at, agency debt these days is like 6.25. Normal commercial debt is probably, local bank, credit union type debt is probably a half a point beyond that, maybe a full point in some cases. But here's the thing: the mortgage rates right now, the 50-year running average for mortgage rates in the United States is 7.74%. So we're smack dab in the middle. In fact, we're on the lower end of that range of historical norms. So, if you can't operate in these environments, you most likely paid too much for the property, and that happens. But like you were saying, I know plenty of operators out there who bought at 3%. Maybe have bought a rate cap, and that rate cap is now under pressure at least. And the fact is that they can't refi out because their refi price is 6.5% when they were holding 3%, and that blows up their cash flow. And so that there are a lot of people who are a little bit of trouble. But I saw Neil Bawa speak, and he made an excellent point. There are 990,000 multifamily properties in the U.S. And you see the Wall Street Journal or the Times or any of those other papers or online, and they're saying the multifamily industry is in peril. It's not. It's 3,000 buildings, right? That's it.
Mm-hmm.
So it's a minute number of buildings that are under that rate pressure that we're talking about. But nevertheless, that's what makes the headlines. So, I'm bullish on multifamily, but you have to buy it right. And in fact, every offer we send out these days has kind of two components to it. One is if we buy it with bank debt or credit union or whatever, agency debt or whatever, depending on how big it is. And that's one price. And that price, we won't buy unless there's a 2-point spread between our debt costs and the cap rate we're buying at, right? So if our debt is 6%, right, then the most we're going to pay is an 8 cap, right?
Mm-hmm.
And so we provide the offers based on that model. Now, if they want what they're asking for, and I have this conversation multiple times a week these days, is I am happy to pay a 2021 vintage price if you will give me 2021 seller financing at 3%, that same vintage, right? Because then I can make the numbers work. But and most of them get it. You get a kind of a sly smile from them, and you're like, yeah, I know, right? But there are still a lot of folks that cross their arms and say, no, I'm dug in, and I wish them well, and I pray for them because they're not going to get their price, and it's going to be a while. So if they do, because I think the dumb money on the street is kind of shaken out at this point. I think the folks that are making bids these days have their act together.
Yeah, I really like that from the standpoint. It doesn't sound like you're going out there and forcing yourself to buy deals just to get into deals, just to raise capital. You're going out there and making sure you're finding these good quality deals. And I think that's super important because I've seen a lot of operators and sponsors, they're finding so many deals and they're putting, they're raising so much capital. And sometimes I wonder to myself, are you actually vetting these deals? Or are you just bringing them on? Do you have sort of a strict guideline? So I do like to hear that you are, very properly vetting these deals. And I thought it was funny that you mentioned about the mortgage rate. I know when me and my wife were buying our house, obviously not an investment property, but we could have got our fixed rate was like 5.5, or we could have done a 10-year ARM at 5%. It would have saved like $100 a month. And I was going back and forth. I was like, what should I do? And then I looked up the historical rate and I was like, the historical mortgage is like 7.5%. It's like even 5.5% fixed rate over 30. That's still cheaper. And then I can always refinance if it does go, say, 3%, 4%, not that I know we're going to see that in the next little while. So I think that's a super important point that you brought up. But when it comes to the properties that you are going out there and buying, say, whether that's Connecticut, North Carolina, these other states that you're looking into, do you go into it with a game plan of saying, hey, I want to hold this property for 3 years, 5 years, 7 years, or is it just more dependent on a per property basis?
It is definitely dependent. Our model is based on an average 5-year hold. But that said, everything, I get asked all the time, any of your buildings for sale? And my answer is always, they're all for sale. You make me an offer at the price, at my target price, we got a deal, right? So if somebody's going to come in 3 years and offer me my 5-year price, we're gonna work that deal out, right? But the the fact is that we go into these with kind of on the building acquisitions, we go into these deals with a 5-year model in place, and we communicate with the investors. This could be 3, it could be 7. We're basically targeting a specific return and a specific sale price point or offer point. And when we get that is when we either refi or sell. And in most cases, we're selling and trading up. On the development side, that's more of a 10-year hold, right? Because there's a lot of capital to be put into the property in the first couple, 3 years. And you really don't start to see really, market expectation type returns until you get into the 7, 8, 9, 10-year range. And so we go into it very conservatively. The thing is that there was a lot of quick money made over the last 5 years, responsibly or irresponsibly. I'll leave it to the audience to decide. I have my own opinion. But the guys chasing act fees, they did very well, right? But it's coming home to roost, as they say, also. But the fact is that we buy slowly. We finance as best as we can. I can't remember the last time I did put 30-year debt on a building. I'm sure I did it, but I can't remember. And the fact is that we go into this knowing that real estate is a marathon, not a sprint.
Yeah, I think that's perfect, especially for those listening with these operators that saw quick success in the last couple of years. And I think it's important for the audience to understand, at least for me, when I was looking at deals, I try to underwrite them myself. And talking to you, Ed, today, sounds like everything you do is conservatively. But if every time I hop on a call with a sponsor, they're always telling me we underwrite conservatively, and that sounds good. Maybe the equity multiple, say 2x over 5 years, the IRR, whatever it may be. The equity multiple sounds reasonable, but sometimes I might say 3, 4, and then you start to say, hey, let me dig into this further. Right. And I found that for me as a passive investor, as you start to dig further, you start to look at things like, what are they projecting the vacancy rate? How much are they going to increase the rent? So I think someone listening, you always got to do your own due diligence on these deals and not just take the word of the operator and sponsors. And again, Ed, I think you sound very conservative. So I'm just pointing that out to the audience, where sometimes you talk to these sponsors and operators and they say, hey, I am conservative. And then you look at their deal and you're like, wow, that's kind of scary. That you have fixed rate, you have variable rate debt. That doesn't sound too conservative to me. Different things like that. But let's say someone is listening to this podcast today and they say, hey, he knows what he's talking about. I love where he's looking for his deals. What does it look like when someone hops out on that prospective investor call with you? Are you just, getting some feedback on their background, looking for some of their prior experiences, or just like more of a, hey, get to know you type of call?
It's so I look at this as dating and then marriage, right? And so the first call it's a first date. I want to know, where are they in their journey, financial journey? Where are they trying to get? What is their timeline? How are they going to use the money over the course of, once we return it? And that indicates to me what type of project, we can put in front of them going forward, right? We tend to curate different types of projects for different people. And someone who is investing with their self-directed IRA is, and then they're in their 30s, they're thinking it's huge long term, right? 20, 30 years. And so that is one type of project, maybe a development project, maybe more in line with what they're looking for because of the long-term returns over that, 8 to 10 year time frame. Whereas somebody who's my age, I'm 54, the line is a little shorter, right? And so, that may indicate, one of the private equity funds that we have, or where we're investing in, very short-term deals. So we just announced a debt fund, or actually by the time this is live, we'll announce it. That is, focused on funding short-term projects. So flipping small multifamily, acquisition type deals. And, so the hold there is, anywhere from 6 to 18 months. So it's, much shorter. Syndication, maybe or in some cases joint ventures, depending on the deal. They tend to be, 3 to 5 years, maybe 7 at the outset. And that, the only reason we would hold for those extra couple of years is if another 2008 happens, right? You just have to let the rain pass before you go back out to the market.
Yeah, that's a great example of handling a call with a potential investor. And I just think to myself, I had a call on Friday with a company. There was another multifamily company. Seemed interesting, but showed up to the call, called me 5 minutes late. So should I even take the call? So that was sort of the first red flag. And then when I was on the call, I don't even think they asked me like what I was looking for. It was just, here's everything about our
So,
company. Here's what we've done.
yeah.
And then they booked it was a 15-minute call. So now we're down to 10. And then they spent 10 minutes explaining their company. Said, okay, I'll add you to our investor list. I was like, well, I didn't even tell you what I'm looking for. If you have those properties coming up. And,
Yeah,
and
a
I
lot of
find,
those guys.
yeah, and I find a lot of folks do that, which is pretty crazy, where it's just more, here's all the great things about our company, which is, yeah, I want to learn about that and your background and different things, but I also want you to sort of get an idea of like what I'm looking for per se. So I think you do a great job of that. And
Thank you.
let's say again, someone's listening to this, they're like, I don't even, maybe they have to have the call with you, but they say, okay, now I'm ready to invest with your company. What does that look like after someone has made that investment? Is the communication monthly? Is it quarterly?
Yeah.
Is it webinars? What does that sort of look like?
So it's on a systems perspective, it's monthly. But every single investor on the, within one of our deals has my personal cell phone. They can call me anytime. And the fact is that, uh, I have, it's interesting. I work with a lot of C-level executives, and type A, I've got it together, masters of the universe type personalities, right? And almost to a person, they ask, well, why can't I do this myself? And my answer is, you can. You just don't have time because you work 80 hours a week and you have a family, and unfortunately you're a human being and you require 6 to 8 hours of sleep a night. So a third of that time of the 168 hours you have a week is in your bed. So that's not possible. So if you are interested in doing this, I'm happy to teach you everything. I always tell people I'm a cheap date, right? For over a cup of coffee, I'll answer any question you have, and I will do my best to teach you some sector of the market that is interesting to you. In most cases, I'm even happy to buy the call. So, but the fact is that there are lots of investors within our world that we give them access to the point where they're basically looking over our shoulder as we're doing stuff, and because they want to learn how to do it themselves. And so I welcome that. If we have, and we've had, a couple of investors who have started to buy on their own over the course of time, and I view that as a win, right? So
I've thought about that to myself. Why don't I just go out and buy the properties? And then I remember I don't want to deal with all the headaches. And I enjoy being a passive investor and having
yeah,
someone like yourself where I can, you can help guide my money into these deals and be that steward of the one going out there and finding the
right.
properties and putting the property management team. And then I start to go down the list. I'm like, yeah, I got enough going on in my job and with my family. I'd rather just, I'm not going to be able to pay 100% attention to this deal
Right.
and what's going on. I'd rather have someone like yourself, Ed, that knows what they're doing, can find the deals, can manage the deals and all that good stuff that comes with that. But Ed, it's been great talking to you today. And if our audience is interested in learning more about yourself or about your company, where should they go? Where should they be going to?
So the fastest way to get to me is at clarkst.com, which is our website, clarkst.com. I'm Ed at clarkstreet.com. And you can also find me and our company. I'm Ed Mathews with one T on pretty much every social channel that the folks in Silicon Valley have built. Likewise, Clark Street Capital is everywhere as well. So we're pretty easy to find. And then lastly, if you want to connect on a podcast like this, we also have our own podcast called The Real Estate Underground. So, and that's more educational based.
Awesome. I'll make sure to include all that in the show notes of today's episode. But Ed, thank you so much for coming on to the show today. I really enjoyed our conversation.
Likewise, thanks, Trevor. I appreciate the opportunity.